What if I told you that one of the Warren Buffett's most powerful investments is not Apple, Coca-Cola, or American Express, but a boring railway business that most retail investor would ignore in 5 seconds? Make sure you subscribe to the channel so we can reach 1000 subscribers. Thank you very much. The business is bnsf Railway, also known as Burlington Northern Santa Fe. And this one case study teaches a very powerful investing lesson. Sometimes the best businesses are not exciting, they are unavoidable. BNSF does not sell a trendy app, it does not launch a new phone every year, it does not depend on hype, influencers, or daily consumer emotions. It simply moves goods across America: food, coal, industrial product, agriculture, container, fuel chemicals, cars, raw material. BNSF operates over 32,500 route miles across 28 US states and 3 Canadian provinces, making it one of the North America's largest free rail network. But here is the shocking part. This boring railway produced around $23.35 billion in railroad operating revenue in 2025 and $5.48 billion in net earning for Berkshire Hathaway. Now ask yourself one simple question. Why did Buffett buy a railway? The answer is moat. Not a brand moat like Coca-Cola, not a network moat like Apple. This is an infrastructure moat. To compete with BNSF, you cannot just open a office, hire employees, and start a website. You need land, you need tracks, you need terminals, you need locomotive, you need regulatory approvals, you need decades of route building. You need billions and billions of dollars, and even after spending all that money, customer may still prefer existing network because it is already connected to ports, factories, farms, and distribution hubs. This is where the real story starts. A railway is like a toll road for the economy. When goods move, the railway earns. When factory produce, the railway earns. When farmer export grain, the railway earns. When the retailer import products, the railway earns. This is why Buffett like hard asset business. They may look slow, but they are extremely difficult to replace. In India also, we understand this very clearly. Think about ports, airports, transmission lines, pipelines, rail corridors, and highways. These assets are not created overnight. Once they are built in the right location, they can become economic checkpoint. Most investors completely miss this. They chase fast growth but they ignore high barriers. Fast growth attract competition but strong barrier protect profit. BNSF mode comes from three things. First, the physical network. Second, cost efficiency. Third, replacement difficulty. Moving heavy freight by rail is often more efficient than trucks for long distances. One train can move a massive quantity of goods with fewer people and lower fuel use per ton. That creates a cost advantage, and this changes everything. If a business has a cost advantage and the asset is hard to duplicate, it can survive many cycles. But this does not mean BNSF is a risk. Railway business are cyclical. If the economy slows, freight volumes can fall. If coal demand decline, one revenue stream comes under pressure. If labor cost rise, margins can get hit. If regulator becomes strict, pricing power can reduce. Berkshire itself say BNSF face competition from trucks, other railroads, barge, ships, pipeline, and its main western rail competitor is Union Pacific. So the lesson is not that every railway is automatically a great investment. The real lesson is deeper. Buffett bought a business where the downside was protected by hard asset and the upside come from long-term economic growth. Berkshire acquired BNSF in 2010 and the deal valued BNSF equity at about $34.5 billion. Today, investors study this deal because it shows Buffett evaluation. He was not just buying a cheap stock anymore. He was buying irreplaceable assets that could keep producing cash for decades. That is the power of an infrastructure moat. It may not look glamorous, it may not double in few months, but it can become a compounding machine when bought at right price. So the key takeaway is very simple. In investing, boring can be beautiful if the business is essential, hard to replace, cost efficient, and financially strong. But boring is not enough. You still need valuation, debt discipline, demand stability, and management quality. Great assets create wealth only when bought with patience and logic. If you learned something valuable from this video, like the video, subscribe to the channel, and comment your opinion on BNSF. Thank you very much. See you in the next video. Bye bye.